Good evening. This is part two of the video. We left off column E here after doing a scan of the GL detail and looking at the adjustments that had to be made to the Yellowstone invoices being coded to common. We shifted 6,300 out of common into townhome exclusive on that basis, and 72 out of general into townhome exclusive on upon a review of the GL detail. Okay. And so from here, I'm going to hide these two tabs and look only at the adjusted total. This is the good stuff. This is how we divide up the expenses among either townhome or single family home. So I'll talk first about income. You'll notice that the GL detail starts at account 5,000, right? Uh, and so it doesn't include the 4,000 series. So how do we know that the numbers that are being recorded to the 40,000 account or the 40,001 account are in fact coming from a townhome owner or a single family homeowner? And my understanding of that is I'll pull up some year-to-date information I have from this is through August 15th. But it basically a if we look at the information in this is the GL detail. Let me put my finger on the row here. The GL detail through August 15th, 2024. Um, Take a look at the billing source in column N of, you'll notice we're at like 5,000 rows here in the GL detail versus the total GL detail for just the expenses was equal to like less than 600 rows. So when we include the sources of revenue in the GL detail, it gets much larger to scan. But basically, I think we have reliance on the internal controls at AMG for how they record this on account of starting at, for example, assessments. The code is a single family payment source here coded to an assessment. So in order to make a remission to AMG for Almond Glen, you have to have an address. Those addresses are coded to either a single family payment lockbox or a townhome lockbox. So those have been there for a very long time. And kind of skipping past a couple thousand rows of single family payment source rows here being coded appropriately to account 40,000. Um, and into townhome assessments, account 4001. Um, okay, being townhome assessments. They are in a townhome payment source, right? Um, and so a townhome owner contributing to the community gets coded as a townhome payment source and gets um, quoted to account 4001. And so that's how we can have reliance on the where's my main file here? Uh, yeah, that's how we have reliance on the single family home or townhome only assessments rows, which are really the most important rows in the file. And so from here, interest reserves are, we'll get into the methodology in just a second, but the other sources of income are interest. Again, from the first video, cash interest is run through the income statement when it is received, basically when the investments mature, okay, through AMG, and so this $2,600 that you see here is the cash upon the former CDs maturing that matured in 2023. But the interest accrued of 19,000 from the first video is not run through the income statement. until that cash is received, and we did receive a lot of that cash. If you look at the same statement from 2024, this is 2023 net income, but for 2024, you see all that interest accrued maturing, and so that is allocated on the basis of basically beginning of the year balances, and we'll look at the reserve study for that um, allocation. Late fees. This is something that, as far as late fees being calculated, touched on it in the last video, but basically, we could go to the level of trying to figure out, $2,200, how much of it was recovered late fees from a single family homeowner or a town homeowner. And, maybe it was more like 50-50, but right now we're just allocating it on the basis of number of homes, which is, a proportion I've talked about a lot, which is 21.7, and the balance 1 minus 21.7 for late fees and pool fees. So, again, $160 here, right? We're allocating it on the basis of 21.7%, which is 64 over 295 as a proportion. Can do a evaluate formula and show you evaluate formula. 64 over 295, 21.7 times the pool fees of 160. So, we could look at this and say, well, if this is $20 a pool fee, so eight fobs, $20 a fob. So we could look at the detail and we could say, oh well, 6 of those 8 fobs related to townhomes, and so we could put 6 times 20 here, and we could put the balance, something like that. And we could put the balance to single family home, but it's such a small dollar amount, level of detail doesn't move the needle, that we allocated pro rata based on the number of homes. Okay. So from here, let's look at how the interest reserves is calculated. So the interest is allocated, rather, not calculated. We already talked about how it's calculated. It runs through the income statement when cash is received by AMG. Um, and how it's allocated then, rather, is basically on the basis of beginning of the year reserves. So, we have beginning of the year reserves from a reserve study. So this is a document. This is a tab from the reserve study document that we got. So, the reserve study, Reserve Advisors gives us the pages in the reserve study in Excel, basically. And so the balances that they came up with are balances that we provide to them, right? We provide them the balances. We tell them how much the townhomes have and how much the commons have. And so, we track this internally. It was tracked in the past, basically using a series of transfers from, the checking account to the savings account, and different savings account for each townhome and common, and then separate investments for townhome and common. And so moving forward, we'll basically be tracking it using the equity section of the balance sheet instead of the asset section of the balance sheet, which gets messy, right? The asset section of the balance sheet gets messy when CDs mature, and then you have to roll that into a different CD, and how to account for it on the asset balance versus straight equity. It doesn't move, equity doesn't change as much. It's a one-time entry once a year, and so that's going to be a cleaner way to do it going forward. But basically, these balances are calculated internally and provided to reserve advisors. So it looks like March 16, 2023, and I've been treasurer since July of 2023. And so this is kind of before my time, but taking a look at these proportional balances to try to understand, okay, how much is townhome and how much is related to common, and then that's how we divide the interest from there on that basis. So, here, a reserve basis of about 250 divided by a total of 831 gives you a percentage of We do a evaluate formula, figure out what that percentage is. Oh wait, that's not the right formula. Beginning of year. That's not the right. That's the right formula, just not the right row. Evaluate formula. Here we go. Is a proportion of about 30%. And then we multiply that times the interest received in cash, and that's how we get basically $700, $780 added to the townhome column. Okay. So we'll take this column by column and we'll just run down the rest of it. Okay, so bank charges, tax prep, and legal expenses are all pro rata based on number of homes. Okay, that's 64 divided by 295 or 231 divided by 295. Okay. So another way to say pro rata number of homes is everybody pays for it. Okay. Trash removal is townhome only. Oh wait, I skipped a couple rows here. So we'll come back to insurance and maintenance and landscaping. But bank charges, tax prep, legal, management services, meetings, accounting, property tax, reserve study, website, admin, late fees to management co, electricity, water and sewer, clubhouse telephone, gate maintenance. Okay. All of those, everybody pays for. Irrigation repairs, everybody pays for. Pool contract, everybody pays for. Okay. Pool permit, pool maintenance, repairs, supplies, everybody pays for everything. Okay. So the formula here to see that very clearly is, we take the proportion 64 over 295 and we multiply it by the total. So that's effectively we'll go into evaluate formula here. Right, 0.217 times the annual expense. And that is how we get that number. And then we subtract out the total minus the portion attributable directly to the townhomes. And we get the rest of it. And so said another way, right, we have this times 295 times 231, and that's how much a single family homeowner pays, and that's how much a homeowner pays. Okay, so it's the same calculation. If we were to take this dollar amount, divide it by 295, which is actually what I do down here, right? That's exactly what I do down here. But take the dollar amount and divide it by 295 and then multiply it back out by the homeowners. It's the same math. Math comes out exactly the same. Okay, great. So now let's talk about maintenance next. General maintenance, we already made the adjustments. So general maintenance, everybody pays for everything that goes to the general maintenance account, and so that's why it's important to keep that account clean. And then only townhome owners pay for townhome maintenance. Okay. As far as landscape contracts, we'll get into the landscaping next here. So the landscaping estimates that we were working on before are outdated. The landscaping estimates that we're working on now are, more precise. If you watched hour mark 2 of the August 19th, 2024 video, we circled in MS Paint these areas together as a board that were common areas. Monica Coram of Yellowstone clicked on the areas in her software and came up with the clicked on areas are common expenses and the other areas are townhome expenses that are serviced. And so it's based on square footage and the man hours it takes to perform the work in the square footage areas. So you can read this email if you'd like to pause the video and read the email, but I basically asked, can you give us the calculation files behind the 3443 and the 2913? And she said she can ask DevOps, but I didn't go to that level of detail because this is reasonable and in line with what we got from US Lawns. And basically the way that the landscaping is done is we take these costs that Monica provided to us, which is the exact same level of detail that we had and that we signed for with US Lawns. Matter of fact, Yellowstone might even be a little bit more accurate because US lawns got divided exactly on the basis of if you take this 3576, 19, 5, 48. Oh, no, never mind. So I should just use Excel for everything. Um, where are we here? 3576 and 19548. Yeah. So you see the Yellowstone estimates were, you know, very much so in line with the US Lawns estimate, which looks like they used to be on a 61-39 split. Um, and we're able to get to Yellowstone came back to us with what's effectively a 62 0.2 and 37.8 percent split. So it was reasonable on its face without going and getting making a DevOps request, given that it took us several weeks to get this first level of detail back, and um, felt good about that. So basically the way it's booked from here is exactly the way it's always been booked. The landscaping contract for the common spaces are pro rata divided by number of homes, and the townhome only expenses go only to the townhomes. Same for miscellaneous landscaping and common areas. Pro rata number of homes. Balance goes to the balance after the town homeowners contribute to the expense goes to the single family home column. And as far as this expense here, right, the 66031, how do we know that this 19.3 is accurate within the account 66031? Well, that's the scan of the GL detail that we did, in the first video. And so we can feel good about that as far as landscaping and maintenance goes. Okay, very good. So now let's move on to insurance. Insurance here is basically another big change that happened. If you take a look at what changed since the August 19th meeting, the biggest changes were that we got an updated estimate from our insurance vendor. Here we see actually that the insurance vendor didn't calculate the 91% that we were going off of. Says, I believe the 91% was calculated in error. That's from him, right? So he gave us some revised estimates. Gave it to us in a good format. We pushed for a better format than a wall of text email. And so we have a different tab for each year, and our premiums at the top: 22 to 23, 23 to 24, and 24 to 25. And the split changed. Pretty dramatically from the original 91%. It changed to essentially be. I'll run through this because this is important. Right, 99% of the cost is uh, property coverage. And of that, 94.5% of the property coverage is townhome property, and then 5.5% is common property. Okay, these are estimates that come, well, estimates, percentages. These come directly from the insurance vendor. Okay, um, this is the same. Um, so I got a 3-year history from him, and then 1% of our insurance cost comes directly from comes actually from the not property that's covered. So, director and officer liability insurance and things like that. And so doing a little bit of math over here, basically in terms of, what's townhome only, 93.6, and then what's common is 6.4. Um, and so feel free to pause the video, look at the formulas. But basically the townhome share of the common is 1.4, and the single family share of the common is 5.0 as far as percentages go. And so we get down to the second half of the right total premium breakdown 95.5. So I was able to break that down into townhome and single family home the same way that he did, using the townhome and common approach that we do. So I feel good about the estimate. I wasn't able to recalculate the previous estimates that he provided, which made sense because they were wrong. That's why we used to just make the decisions based off of we used to just make the decisions really just based off of the number of homes, number of property elements covered rather. So there are 13 townhome buildings and two common property buildings. And so we were using the fifth split of 15ths as a, estimate before getting these much better, much cleaner revised estimates from the uh, insurance vendor. So it's very good. We went back to the insurance vendor on that. Yeah. Okay. So from here, we basically take the estimates. So this is you can see the formula bar H4 and H6 from the insurance tab. So that's H4 and H6. H4, feel free to pause the video, look at the formula inputs. Taking the townhome times 99%, and taking the common times 99%, times the proportion of 21.7, plus the liability insurance. Okay. So feel good about that. And then one minus the balance going to uh, the single family homeowner. Okay. Well, good. So now that we've basically run through the estimates entirely, the way that these are allocated, most of them you can see are on the basis of the prorated number of homes, but the vendor estimates related to landscaping and insurance are extremely important, and glad we can get them tighter on that. So kind of from here, right, the 55669 that we were looking at from the previous video, 55669, is broken up into the same formula. We take the 4,000 series accounts minus the 5,000, 6,000, and series accounts, and come up with a net income, okay, for each side. Okay, so that's townhome and single family home. Okay. And pay attention to this next part. I don't want to lose you. So I'll even do actually a freeze panes so you can see where I'm going with this. I don't want the column headers to not be visible. Uh, View freeze panes. So, right, 100% of the single family home net income goes to the general fund, and then divided by homeowner, the number of homeowners, 231 homeowners. You can kind of see up here. Town homeowner contribution to match is also $65 per homeowner, times the number of homeowners up here. Um, J1, right? Feel free to pause the video, look at the formula inputs. Town homeowner contribution minus the town homeowners contribution to the general fund equals the town homeowners contribution to the townhome specific reserve fund. Okay, great. So I'll walk through that one more time. All of the single family home owner net income goes to the general fund divided by the number of single family homes, gives you a per home contribution to the general fund. Multiply that by the number of townhomes, gives you the portion of the townhome net income that goes to the general fund, and then the balance of townhome net income minus townhome portion that goes to the general fund equals townhome portion that goes to the townhome reserve fund. Okay, very good. So from here, right, you can get to the finally level of detail that was in the homeowner analytics from the first video, um, which is basically taking every row above and dividing it by the number of homes, either 64 or 231, because these are all annual costs here, right? These are all annual costs. And so you divide them by number of homes and you get an annual, per home owner And so I started out here, right, the general contribution because I only paid in, this much. I didn't pay in 2651 into the association. I paid in 2580. So the miscellaneous income explained here helps, reconcile that for the homeowner of what do you mean I paid in 2651? I only paid in 2580, but then they got a little bit of pickup on the basis of late fees and interest, cash interest, and then timing differences here. So timing differences in terms of cash received versus when the assessment was is what's going to explain the differences here that I kind of just called miscellaneous income, but we could break this down further into saying timing differences, and assessments when the assessment is expected to occur, which is just on a schedule of, first of the month versus when it's actually received by AMG, creates the difference there, but the addition there, I should say. But then here, this functional category, this is of my own doing. This is not anything AMG did. This is just functional category, something I thought would be helpful and beneficial, for the purpose of breaking down the homeowner analytics tab in the or slide rather in the PowerPoint. So this functional category here, right, is me. So I basically just called assessments, base of income, things that are not assessments, miscellaneous income, bank charges, miscellaneous expense, tax prep and legal expenses, or professional services, insurance, management co, annual meeting, property tax, website, more management co for admin and late fees to management co. Utilities encompasses electricity, water, sewer, and clubhouse telephone. Townhome only trash removal is the trash removal account. Common maintenance, townhome only maintenance, common landscaping, townhome only landscaping, and then pool cost. So this is, and this multiplied back out gives you the exact same, net income that we were looking at, this 55, 669, 55, 669, and then each homeowner's net income divided or multiplied back out by the number of homes times 64 times 231 gives you the 55669 that we established in the first video is able to be relied upon because it ties back to the audits that we get. Okay. So, okay. Wow. Hard to believe we're done with that. So from here, what we'll do is basically make a journal entry. So this journal entry is important because right now we, have I'll pull up the July 2024 financials. These are as of July. We usually get our statements 15 days after the end of the month. So we'll have August by September 15th. I'm not sure why it takes 15 days exactly, but we've tried to get it closer and it just never is. But basically, you can take a look at the December. No, we don't have the December balance sheet on the screen, but this number sits on our balance sheet like a bump on a log and doesn't actually give us any analytical value. So we'll repurpose these two accounts, these two equity accounts. We know they're equity accounts by the 3000 series. We'll repurpose them to be general fund reserve. I use the same terminology between general fund and common fund. I mean the same thing, but general fund and then a townhome reserve fund there. So follow my entry here. Basically, what we'll do is we'll back out the amounts in the let's see. I obviously can't instruct journal entries without board approval, so some of this is me making a presentation to the board on this, but so what we want to do is track this closely going forward, right? We want to be able to calculate net income on each side going forward. We've never had the level of visibility into the homeowner analytics that we've had. We've never had the level of calculation that we've had, the level of accuracy with actual dollars versus budgeted dollars. And so this is an exercise that we certainly want to continue into the future. And so the way to do that is, first wanting to rename account 30,000 to common fund reserves. account 3100 to Townhome Fund reserves, back out the balance. So you currently have credit balances sitting in the equity account. So you want to debit those to back them out, and then credit them equal to the value of what was the at beginning of the year cash. Really, in future years, it's going to be beginning of the year reserves. So you'll notice the reserve advisors gave us a value of 831 as of I think that's total reserve balance is probably as of like March 16th or um we see here beginning reserve balance date 4/30/2022 or something like that. But that doesn't make sense. You know, we don't have $831,000 in reserves as of beginning of the year 2020 three. We have cash equal to 808,000 at the beginning of 2023. So, the first thing to do is to take the proportionality of reserves here. Um, as of the reserve study, the proportionality is 0.229 and 0.7008, and multiply that by our beginning cash. And so our beginning cash was tied out to the audits. And so this amount is also, if you take a look at, we have right now these balances equal to 864 sitting on our balance sheet. So we can't tell them to, 831 and take the net income here, 831 plus 56, 887. You can't tell them to debit out equity of 881 because there's only 864 sitting in the equity account. And so the way to tie out the current equity on the balance sheet is to basically do a proportionality of what the reserve balances were as of the reserve study. Looks like, this 831, it might have been calculated as of 4/30/2022. That doesn't make a lot of sense to me because we had them out here as of March 16th, 2023. This might have been a date that we had certificates of deposit, but fiscal year beginning, whatever the 831 actually composes. The important thing is we had 808 in cash that we can rely upon per the audited statements, that we can do a proportion on. So we're using not the 831 as a basis of cash allocation, but we're doing it on the basis of proportionality. So proportionally, in the 831, 29.92 was the townhome portion. So multiply that by beginning cash, and that'll be the starting basis for townhome fund reserves as of 2023. Common fund reserves equal to the proportionality that was in the reserve study multiplied by beginning cash. Okay. And then multiplied by or added to our net income for those balances. So net income of the common fund is here. General fund net income, which equals single family homeowner income plus townhome portion of single family homeowner income matched dollar for dollar, penny for penny. Added to the common fund reserves, and townhome fund reserves get increased by the townhome net income, which is townhome owner dollars minus their contribution to the general fund reserve, and we get a new proportionality. And so this is our entry that we'll basically want to instruct AMG to make. So this is going to say that going forward on a go forward basis, starting as of 12/31/2023, for an entry that's going to be made in September of 2024, but we'll basically use the equity portion of the balance sheet to reflect. We'll use the equity portion of the balance sheet to reflect the way that actual dollars are divided among the community. So, okay, I think I talked about all this very fast. But okay. Yeah. I hope that helps. So we'll go to the FAQs. So I'll breeze through these, and this is also in reflection of everything that I've talked about. So the FAQs are the single family homes subsidizing townhomes. No. I would say a subsidy of the single family homes subsidizing the townhomes would basically mean that the townhomes are in a net loss position, and that single family home dollars are needing to be used in order to cover costs associated with the townhomes. That's not the case. That's not the case on the actual dollars being calculated. Are the townhomes matching the single family homes general fund reserve contribution? The answer is yes. Dollar for dollar, penny for penny. In 2023, $64.94 was contributed by every member of the community to the reserves for the general fund, and then remaining 570 was spent on the townhome reserve fund contribution. Okay, are the townhomes meeting their reserve funding requirement? Okay, this is an important question. So there's no requirement, only a suggestion from the reserve study. But if you go off of the reserve study, per the 23 reserve study, the townhome net income after contributing to the general fund was light by about 4K. Okay, so interpret that however you'd like to. Okay, great, facts. You'll recognize this townhome dues and single family home dues history. I got these off the budget letters, which are posted or sent out to homeowners and posted to the website. So, why did single family home dues increase going into 24? It was due to planned spending during 2024. And so that's why they increased. And then the question became, what level should they increase to? And we restored them to the levels that they previously were at prior to a decrease in 2022, going into 22. So why did the single family home dues decrease in the first place? And so this is my understanding of it because I wasn't presiding as treasurer at that time, but the common reserve funding was at a good level by virtue of the dollar matching between the single family home and townhome to the general reserve fund. Reducing the single family home dues actually gave a few more years of relief to the townhome owners and allowed the townhome owner to contribute to the single family reserve fund. Excuse me, townhome fund. Generally, this is something I feel strongly about. Dues should not decrease. Generally, dues should not decrease. So the question, will single family home dues increase or decrease going to 25? I really don't see a reason why they should increase, but they certainly shouldn't decrease either. So they should not change due to the planned spending going into 25, which we've talked about, including a pool furnitures possibly being replaced and possible continuations to the common area landscaping improvements, possibly at the entrances. Okay. Finishing up the facts here. So why did the townhome dues increase going into 2024? This was an additional year of relief to the townhomes after an increase of $600 annually from 20 going to 21. And then this would obviously require a board vote, the same as instructing AMG to make a difference to the journal entry. Would require a board vote. So hopefully we can vote on two things during tomorrow's meeting. Or no, well, actually we wouldn't vote on townhome dues until the November meeting, but yeah, so we'll make one vote during tomorrow's meeting to vote on net income, and hopefully we can get that passed. But townhome dues will likely need to increase in 2025, going into 2025, and this is not something I can say unilaterally. It would require a board vote, but I would recommend to the board, and also as a voting member of the board, just one vote, but I would recommend to the board that the townhome dues would likely need to increase to cover future landscaping improvements. We wouldn't like those to stop. To cover the rising insurance costs, which you can see from the previous work that we did, is 95% of the cost goes to the townhome. And continue to fund the townhome reserves. So we funded the reserves for the townhomes equal to $570 per homeowner in 2023, and we'll keep that going into the future. Okay, what will the townhome dues increase to? That's a matter for further discussion. We'll discuss that openly. We'll be as transparent as possible about it, and give you much time to prepare as possible, knowing that any change would impact any kind of expectations for spending as you make your own personal budgets going into 2025. Okay, wow. So talked a lot, but hopefully that was good. That was helpful. And if you have any questions about the methodology for the journal entry or the allocation, how we allocate things, please feel free to email the allmcglennHOA@gmail.com. And or come off mute during the meetings and ask questions. So thank you so much. Talk to you soon.